Hi, 56% of the Gen Z are losing sleep over their money matters, in spite of the fact that they are earning through side hustles, entrepreneurship, and of course, salary and business. Why is this so? It's because they are not earning enough from their investments. They are not investing their money well. They are going into credit debt and they are asking for support from family. Why is this so? So let's see how they can invest well. This is Shubho from Shubho's Voyage. Few slides I'm going to show where Gen Z can invest and make it big. I'm going to cover the large returns, the largest bets in the beginning. That's the stock market or the equity markets. A word of caution, this is the place where the maximum risk is. So I'm going to start with the US stocks. The S&P 500 2-year return has been 16.51%. The Japanese stocks, they have been doing very well. The Nikkei JP 225 1-year return has been 46.54%. However, again a word of caution, the returns in the previous years 2022-21 have been much lesser than this. The Indian markets for the past 1.5 years have been doing exceptionally well. The Nifty 50 total return index 1-year return has been 28.4% CAGR. And the UK stocks, again, the FTSE 250 annualized return has been standing at around 17%. Again, a word of caution, the returns in the previous year has not been that high. So now I'm going to cover the safe bets. These returns are going to be on the lower side than the equity or the stock market. However, we must remember that the Gen Z has time on their hands. They have a longer time to stay invested. So the compounding effect will take place here. So what are the safe bets? Money market funds, which in Indian funds have been giving an average return of 6%. In the US, the Federal Money Market Fund has been giving a ROI of 5.32% before tax. The CDs, the certificate of deposits, the average 1-year rate has been 1.76%. The bonds, I've covered India and the US market. The Indian 10 years average is around 7.069%, whereas the US overall portfolio reference has been 5.33%. And finally, we come to gold. The gold has given an annualized average return of 13.1% in 2023. It's giving a very good return now. Let's see what happens. And going forward also, I think it has a good outlook. I have not covered bank deposits in separately because the deposit rates are different in different countries and the compounding effect can be different. I shall cover some other avenues of investment here. The returns on these investments varies. So starting with the cryptocurrencies, well, they have done amazingly well. The yearly been standing at around 671% starting 2013, but a word of caution, we are not sure how it's going to proceed in the future. However, the Gen Z can take a look at it going forward. Real estate, the average return on investment in the US real estate market has been 10.6% in the residential space. In the commercial space, it stands around 6 to 12%. The national pension scheme, till now it ranges between 9 to 12% annualized return. And we have the government small savings schemes. This is specifically to the Indian scenario. The rates are different. It ranges from 3 to 8%. So now I would like to suggest 3 pillars, the mix of all these what I have covered till now, and so that the 3 types of investors in the Gen Z category can invest in a specific combination. The first one is the traditional investor where the Gen Z knows that it's a long-term run. So it's the traditional mix should be 20% equity funds, 40% debt, 20% in bonds, 10% in CDs, and 10% in gold. I have kept direct equity outside the purview of this traditional mode. The next pillar is about the moderate fund, where we have 20% in direct equities, 20% in equity-oriented funds, 30% in debt funds, 10% in CDs, and 20% is gold. The reason why I put 20% in gold is the returns have been going up significantly, and so the moderate can look at it, and it's always a safe instrument. The last pillar is the aggressive one. So I'm holding at 50% direct equity, 20% equity oriented funds, 10% in debt funds, 10% in gold, and I've kept 10% in the cryptocurrencies. So here are some simple rules of investment, do's and don'ts. Uh, do look at the long term prospects of any investment. As I said, Gen Z has time. So when we say long term, it's more than 3 years. Invest after proper research. So when you're investing into a share or any instrument, look at the prospectus, look at the financial statements, and keep a regular track of prices and net asset values, because it's no use turning a blind eye into the prices for quite some time. Now we go to some of the do nots. So do not leave money in the bank account without investing. It's a sin to leave money in a bank account where they're paying interest of around 0.1%. Do not be impatient and book small profits. If you're sure that you have invested in a good company, the share price is going to go up. Do not invest blindly into dividend paying companies. The reason why I'm saying is that even if it's a very good company paying a dividend of 80% per year, but look at the cost of acquisition. If the cost of acquisition is very high, then the actual return is negligible. Do not try to time the market. Do not put all eggs in one basket. We have seen in the past where one share stock was going up, but finally it came crashing down because of certain reasons. And do not follow the crowd, the herd mentality. So before I end the video, here are my 5 golden rules of investment for Gen Z. Try to keep 30 to 35% of your income for investments. What I mean is that if you're a salaried individual and at the end of the month, whatever is your net take home pay, try to keep 30 to 35% of that amount in a separate account only for investments. Try to invest regularly and diversify. Nowadays, we have systematic investment plans for investing into stocks and mutual funds, and diversify. Look at the various sectors like auto, metals, banking. Look at investments as a long term exercise. As I keep on harping about the topic that Gen Z has time on their hands, take calculated risks as you go along in this journey, and reduce debt, because long term debts or debts with a very high interest rate are going to burn a hole in your pocket.